All three banks announced their results. In this video, we will go through why UOB and OCBC experienced a short drop in share price before recovering, while DBS shares actually held well and even went up in share price after the results. We will see the differences in the bank's performances and what makes DBS so attractive compared to the other two banks. Generally, in a nutshell, banks are dependent on two main incomes. One is the interest income, while the other is the non-interest income. Interest incomes are the incomes that they earn from the interest of the debts, which are essentially the differences they make using the customer deposits. Non-interest income are the rest of the incomes of the businesses, such as credit card fees, wealth management fees, and trading or investment income. For UOB, they have the potential for huge growth in non-interest income due to the expansion and integration of the consumer businesses that they have previously purchased from Citibank Group. So it's important to see that as they integrate these businesses, it should benefit their business as a whole. If we see their earnings summary, for the non-interest income, it continues to grow strongly with the fee income and trading/investment income increasing 20% year over year. It's very impressive for bank standards and is showing that the integration is coming into effect. However, the net profit after tax actually came in lower quarter over quarter of negative 2%, with year over year remain unchanged. Now, you might be wondering why would the net profit drop even when the income is up by such a huge percentage. Later we will see in the next slides for the main contributor for this drop in profit and why it might not be a big concern. Net interest income is stable at 2%, which is good, and I would expect it to maintain this way. With the interest rates dropping, it's definitely not good for banks as their interest loans to people will be lower. However, to offset these cheaper loans, they can drop the interest paid to savings account, which can be seen from all the current saving accounts interest rates drops. Moreover, cheaper loans means more people will start borrowing, which can be seen from their higher loan growths. This is why even with lower margins, their net interest income actually might not change much. Non-performing loans are still quite low at 1.6%, while UOB still have plenty of cash reserve with CET1 ratio at a high of 15.5%. Looking at the balance sheet, net interest income is stable with a slight drop quarter over quarter of 2% but up 2% year over year. Non-interest income came in very strong, therefore the total income comes in at 6% positive. Although operating profit came in higher, we can see that the net profit is actually down. The main reason why is because the banks have increased their allowance significantly by 28% quarter over quarter or 78% year over year. Allowances are essentially money set aside in the event where debts or loans are defaulted by the personnel. This is usually done as a precaution measure, and allowance can be put back into profits if the banks deem the situation to be safer. Later, for the rest of the banks, we will see if they increase their allowance as well. Therefore, the increase in the allowance that resulted in lower net profit is never a bad thing, as this does not indicate poorer operating performances. Their operating profits actually came in higher, which means that the business are doing better. Another small win is their drop in the expenses of 1%. Singapore banks have recently mentioned a lot in their earnings call on the implementation of AI, which results in companies saving costs, and this will definitely be beneficial for them in the long term. This slide summarizes some important parameters for UOB Bank. The increase of 18% in CASA means that there are more monies actually being put into UOB savings account. This is definitely beneficial for the bank because this means that they have more deposits to loan out and earn more interest income. Card billings and wealth management increased by 8% and 25% respectively, which is important for their non-interest income. This growth is good as this will ensure that the bank is less dependent on their interest income and thus less impacted in the event if there is a huge cut in the interest rate. Loan margins decreased to 2.4%, which is expected with total net interest income dropping slightly by 2%. However, net interest margin maintains at 2% thanks to the offset from earnings from interbanks and securities. The non-interest income will be crucial for the three banks' growth in the near future, considering the interest rate will start coming down. UOB is doing amazing with 14% higher thanks to fees from higher wealth management and loan related. As they gain more customers, I will expect their growth in this segment to continue growing strong. Cost to income ratio is an important parameter as it's another way of showing the cost efficiency of the bank. For the past few earnings, they have mentioned on the high cost to income ratio due to additional expenses required from the city's integration. However, this quarter they have removed it and the ratio has came in good at 42.6%, which is one of the lowest ratio from the past 5 quarters. This is good because this meant that their operations are becoming more efficient and profitable. More profitable business is always good as this can translate to higher amount of income that can be rewarded to shareholders in the form of share buybacks or increasing dividends. No changes to their non-performing loans at 1.6%, which is at a very safe level for banks' international standards. Because of the macro uncertainties, they have taken safe approach to strengthen the allowance and coverage in the event of bad loans. Similar to other SG banks, their CET1 ratio is very high. Even with the higher dividends and the constant share buybacks that they've been doing, UOB CET1's ratio has still managed to maintain at 15.5%. This is good as this meant that there are additional capitals that UOB can deploy for expansions or reward to shareholders. As shareholders, it's very important that companies are willing to reward the shareholders by either increasing dividends or do share buybacks when they have a lot of capitals. With the income growing well, expenses decreasing, I'm sure that UOB will be able to maintain their dividends easily at 50% dividend payout ratio on top of the bonus dividends. Thanks to the higher dividends announced, their current dividend yield comes in to be around 6.6%. However, one of the things that is not constantly mentioned is their share buybacks. With share buybacks, it increases the share price of the stock that you hold due to the concentration of the share outstandings. Thus, this is additional returns that shareholders should consider for the long term. If you have liked the video so far, please support the channel by hitting the like, subscribe, and using the affiliate links below for free. Thank you, and let's continue with the video. Next, let us go on to OCBC's earnings. In recent times, they have also made big acquisitions with the increase in the ownership of Great Eastern and the Indonesian bank Commonwealth. Moreover, there are also reports on additional acquisition of Panin Bank, which is good considering OCBC has the highest CET1 ratio and therefore the more amount of excess capitals that they should deploy. Looking at the key highlights results, first thing is to always look at their net profit and total income. Group net profit dropped 5% year over year, while it's positive 12% quarter over quarter. Total income is still increasing year over year and Q over Q, with interest income coming in lower, but was offset thanks to the strong growth in non-interest income. OCBC's non-interest income is still very strong thanks to the higher wealth management fees, trading and insurance income from the Great Eastern arm. For banks that gives dividends depending on their profits, this is definitely a good thing as they can potentially increase their dividends in the future. ROE came in at 13% for this quarter, while non-performing loans ratio is low at 0.9%. OCBC has the highest CET1 ratio at a high of 17.6%, which is a lot of additional capitals that we will see what the management does with. Thanks to the strong growth in non-interest income, the total income increased. Moreover, operating expenses also decreased by 9% quarter over quarter, therefore resulted in higher operating profit when we comparing quarter over quarter. However, for OCBC, they did not increase their allowance that much, with just 2% higher Therefore, net profit was able to come in stronger Q over Q compared to UOB Bank. Net profit was lower year over year, but customer loans and deposit was stronger with 7% and 9% growth respectively. Similar to UOB Bank, wealth management fee income continues to increase well at 6% year over year, while Great Eastern was able to perform better with 24% increase year over year. Like I said, Great Eastern profit is always lower in the Q4 2024 period, therefore it's not surprising for it to come in lower during the Q4 quarter. Net interest margin continues to drop to 2.04%, and we will expect them to maintain at a certain level. Similar to UOB, net interest margin drops, but the net interest income only dropped slightly thanks to a higher loan growth. Like the statement here states, loan yields tightening faster than the deposit costs. So if the bank decreases the interest payment to the saving accounts, this will help to offset the drop in the interest rate, thus benefiting the bank. For the non-interest income, it's good with higher income year over year. This is what we should expect, and their non-interest income to continue growing as they expand their business either through acquisition or expanding to get more customers. Net fees and commission are usually the more stable out of the rest of the non-interest income portion, therefore it's very important for this to continue to grow. Looking at the expenses, this quarter was good as it came down back to the usual cost to income ratio of 38.7%. With the investment made to business growth, hopefully their income will continue to grow and provide higher dividends to shareholders. OCBC's non-performing loan is at the lowest of the three banks of 0.9%, and it should not be a big factor as long as there is no sharp increase in these loans. With the higher profits, OCBC CET1's ratio increased to 17.6%. After adjusting for the special dividends that will be paid, their CET1 ratio will be still at a high level of 16.4%. This shows the excess capital that the bank has, which can be flexible in supporting the business or capture future growth through acquisitions. OCBC continues to maintain their guidance with net interest margin expected to remain around 2%, with mid-single digit growth for loans. With their dividends payout ratio of 60% and share buybacks, this provides good rewards to shareholders. To me, this report is a decent report, and at the current share price, dividend yield will be in the range of 6.4%, as I'm assuming that their 60% dividend payout ratio will be around the pop-up value of 105 cents per share for this coming financial year. Next, let's go on to the earnings of DBS Bank, which has been one of my favorite dividend stocks ever since I've deep dived into the company. I've been constantly buying it since year 2022 and have never regretted ever since. They continue to be the standout performer of the three banks, and because of that, they are able to reward shareholders better than the other two banks. If we see their highlights, total income and profit still reach new record highs despite the building up of allowances. Similar to UOB, they recorded lower net profit due to higher allowance being set aside. Net profit was lower by 2% year over year, but higher by 10% quarter over quarter due to global tax, but the return of equity is fantastic at 17.3%, which is highest out of the three banks. Like I've always said, DBS has been growing their profit so well that their CET1 ratio does not really drop despite the large share buybacks and the huge increase in their dividends. Looking at their year-over-year results, market trading increased significantly by 48%, and I was expecting this as the US bank have also announced higher trading income. Later on, we can see the individual breakdowns of their earnings. But with the increase in the income, while the expenses did not increase that much, their profit came in at 6% higher year over year. As the banks likes to be prudent, additional allowance were announced which resulted in lower net profit. If we see their net interest income, unlike the other two banks, DBS result is strong as it continues to increase year over year. Although the net interest margin falls to 2.68%, but it's still way higher than the 2% range of the other two banks. Fee income is at a record high, with wealth management increasing significantly by 35% year over year. Similar to UOB, this is thanks to the acquisition of Citi Taiwan and the additional investment services that DBS has constantly provided to customers. This will be one of the main reasons why DBS can continue to reward shareholders with higher dividends and share buybacks, even with the interest rate starting to come down. We can see that their net fee income continues to perform well, while the other two factors are performing decently. As expected, their cost-to-income ratio dropped back to 37% range, which is good. This is actually the lowest point when compared to the past 3 quarters. As the Citi Taiwan integration completes and the investment in AI starts coming in, I feel that their expenses might continue to go down. Thanks to the development of AI, they have started cutting their contract staffs as they are no longer required, and this will definitely help DBS in reducing their expenses. There's not much changes to DBS non-profit loans ratio, even though they have increased their allowance, which is good. With the higher income and lower expenses, their CET1 ratio dropped slightly from 17.7% to 17.6%. However, this is accounting for the increase in allowance, increase in dividends, and share buybacks. With the CET1 ratio not dropping much, this provides DBS with lots of excess capital that can grow their bank or reward shareholders in the near future. Thanks to the bonus dividends, their quarterly dividend is at an attractive level of 75 cents, which represents about 73% of the dividend payout ratio based on this quarter's earnings. However, one caution to take is that as uncertainty in the economic grows, DBS CEO has actually warned on the slowdown in loan demands in the second half of this year. However, with the trade talks ongoing and the good progress made by both China and US, I'm slightly optimistic that trade deals would be done and the economy will continue to do well. My stance is still the same, where I feel that the current US government is smart enough to know that having extremely high tariffs is not the path forward. Their outlook is more conservative, with lower net profit expected for this financial year. But considering the small drop in their capital despite the higher dividends, I'm confident that they will be able to sustain this high amount of dividends for some time, unless there's a recession that can cause all the bank's profit to drop significantly. In conclusion, DBS continues to be the better performer of the 3 banks thanks to higher ROE percent and the improvement in the efficiency operation of the banks. At the current share price, its dividend yield is at 6.7% at a dividend payout ratio of 73%. So if we compare the results between the 3 banks, DBS continues to be the one that outperforms the other 2 banks. It's because DBS banks continues to achieve record profits, whereas for UOB and OCBC, they actually reported lower net income if we compare with the Q3 of 2024 results. However, DBS is priced at a premium as their dividend yield is similar to UOB and OCBC, with their dividend payout ratio much higher than the other 2 banks. This means that investors might expect higher increase in DBS dividends, which has been true for the past few years in this high interest rate environment. However, thanks to the bonus dividends paid by UOB, their dividend growth has been good as well. If we include the bonus shares that was given in one of the financial year from DBS, they will have pumped up the dividend growth by way more than the current value that you see here in this Excel. Now, let's see the 3 banks' performances for this quarter. DBS continues to be performing better than the other 2 banks, with higher return on equity at 17.3%, while the other 2 banks are in the 13 to 14% range. This is further supported with higher net interest margin for DBS at 2.77%, while UOB is at 2% and OCBC is at 2.04%. Of the 3 banks, OCBC experienced the most drop from last quarter of 2.15%. Cost-to-income ratio for all 3 banks dropped as their income increased from last quarter, while their expenses did not increase that much. At their current earnings on top of the high excess capitals due to the high CET1 ratio, I feel that the banks will not have any issue maintaining their own dividends. Moreover, Singapore banks were also actively doing share buybacks, especially during the month in April where their share prices crashed. This is a very good move by all three banks, and this return can never be underestimated as their share buybacks will help to drive up the bank stock prices. At their current share prices, with the bonus dividends included, their dividend yields will be in the attractive levels of 6.7% for DBS, 6.4% for OCBC, and 6.6% for UOB. Even if we remove the bonus dividends, their dividend yield will still be in the range of 5.2 to 5.4%. This makes them much more attractive as compared to the current dividend yields offered by REITs, which are currently paying 90 to 100% of their income. There will be risk when interest rate drops, but if the interest rate is being cut slowly, banks will be able to adopt different strategy to ensure that their interest income continues to stabilize or increase. If you have enjoyed the video and would like to support the channel, you can start investing by using my affiliate links below to open your brokerage account and to start investing with free gifts. Please like, subscribe, and comment on what are your thoughts on the bank's earnings. You can also watch my previous analysis video on why blue chip REITs like Mapletree are facing drops in their share prices. Thank you, and I'll see you in the next video.